Hello everyone, my name is Dan Bossi, President of AgResource Company, coming to you from Chicago, joined by Dr. Bill Tierney, just to spend a few minutes on the USDA Crop Report that came out on Tuesday. A big report, Bill, always market moving, and this year didn't disappoint.
Actually, I was a little bit surprised it was as market moving as it is, because usually you don't get that much action around a USDA supply demand report. The report, I think the biggest surprise, of course, was what happened to the USDA's projection for next year's soybean ending stocks. It was 122 million bushels below the average trade expectation, and the market reacted very strongly after that.
Well, normally I think these days logarithmic traders look at the difference between the average trade guess and then decide whether they should buy or sell. Obviously 100 and whatever it is million bushels issued a big buy signal and they got into action. There was also a lot of problems in the options market, I was told, in which short calls were covered very abruptly. And so I think this all fed into itself. But after the dust has settled, what do we think?
Well, I've been running some fundamental models because I don't know what the algorithmic traders trade off of, but what I understand is the relationship between perceived supply and demand and prices today. I was surprised that the price action that we saw fit reasonably well with a historical model that looked at the USDA's May WSDA projection and what May futures prices were, what the high of the May futures, what the high of the November contract during the month of May. So I'm looking at the futures price in the month of May. How does that react to what the USDA says, what the ending stocks to use ratio? They lowered their ending stocks to use ratio to 7.8%, and it turns out that the price action that we've seen so far fits fairly closely with that. Now, the question is, down the road, what do we think is going to happen to the fundamentals that impact soybean prices? One, obviously, is supply and demand for soybeans. The other is what corn prices are doing.
And so on corn, I mean, the stocks came out at 2.1 billion bushels, the largest we have found in nearly a decade. I mean, obviously, we would imagine that would be somewhat bearish, and I think our estimates are even more onerous than what the USDA came out with.
Well, indeed, USDA's midpoint of the range of their price forecast, I think, is $3.35. That compares to this year's season average price of $3.65. So the USDA is saying, we think that soybean prices will go up slightly because their season average price is slightly higher than this, but that corn prices will go down. We think that's a moderating influence. When we take a look at the USDA supply-demand balance table, the consensus in the trade seems to be that they're too aggressive on consumption. They've got a very high feed and residual number. They've got a very high export number. And one of the things that I was really surprised is that USDA did not adjust their historical estimates of China's corn stocks. When I took a look at what USDA is projecting for next year's imports of corn, grain sorghum, barley, and guesstimating what they're going to be importing on DDGs, they're projecting that China's imports of feed next year will be 14 million metric tons compared to 19 million metric tons this year and 32 million metric tons last year, which was a record. And everything that's coming out of China says that China is going to be lowering their corn prices and reducing the incentive to import. And USDA doesn't seem to be reflecting that in their supply-demand balance for next year.
Not only that, Bill, the world trade on corn, to me, looks askew in terms of the big build in world corn, but no change in world wheat. You know, world wheat prices and feed wheat will be very cheap in the year ahead, if indeed weather plays out normally over the next 6 to 8 weeks. That's got to kind of be a blanket on corn, per se, if market December gets close to $4.
I agree. In fact, just the other day, the Kansas City wheat futures contract hit a 10-year low. The contract set a new life of contract low in the month of May. And one of my old wheat buddies from the day when I first started work at Pillsbury, I asked him, what does this signify if in May the July contract sets a new life of contract low? And he said that his analysis showed that 88% of the time the contract goes on to set a new low. The years that it did not set a new low were years where that you had a drought in corn. So right now, it doesn't look for the next 30 to 45 days that we're going to have a drought in corn, or at least a lot of people believing that. So we're likely to see the continued erosion in wheat values, setting new lows, possibly trading down at that $4 level. And as you said, that will be a wet blanket on any bullish enthusiasm in the corn market.
So we know the grains, they look rather bearish. Beans are the wild card depending upon how many acres we get, of course, coming from corn or how much the Brazilian crop grows next year. But to me, it's all about intermarket spreads, which is the grains losing relative to the beans.
Yeah, but how much wider could we be getting than where we are right now?
Probably maybe to 2.8 or 2.9, but we're sitting at 2.75. You're right, we've stretched it out a lot.
Okay.
My name is Dan Bossie, President of AgResource, joined by Dr. Bill Tierney. Thank you for joining us. We'll be back again.